Indian markets erase early gains as Nifty hovers around the 10,150 level. Broader markets trade flat. Indian 10-year bond yields touch its highest level in 15 months ahead of the RBI monetary policy decision on Wednesday. Infosys sees healthy gains, is the top gainer on Nifty as board appoints Salil Parekh as its new CEO and MD. Parekh will take over from the 2nd of January 2018. Biocon holds on to 9% gains in trade after the US FDA clears a biosimilar that is jointly developed by Mylan and Biocon. Well, with that, it's over to Hot Money.
Thank you, Navneet. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show, Kalra of Target Investing, Sangeet Lakkar of Newberry Capital, and independent advisor Vivek Mavani. All of them join us on the show. Thank you all for joining us on the show. Today on Hot Money, we'll be discussing some of the stocks that have been buzzing: Advanced Enzymes, Crompton Greaves Consumer, TRF, Westlife Development, and Coffee Day Enterprises. Let's move on to the first stock, and that is Advanced Enzyme. The counter was up almost 10% last week. Again, the rally continues. It's up another 2% in trade today. What's happening? What's the buzz as far as this counter is concerned, and what is the market view that they have on the stock? I'll start with you, Sangeet. Advanced Enzymes, what do you make of it? It had a very stellar run post-listing, but over the past few months, it's managed to correct. Now, again, the rally seems to be picking up. What do you make of Advanced Enzymes?
So I like the company. It's a very high margin business that they operate.
Yes.
You know, total turnover of about 350 crores. They make close to 90-100 crores of profit.
Yes.
A very big opportunity which is there is in the palm oil segment. So they have developed a patent wherein the productivity of palm oil is going to go up by 30%. That's being launched next year. So I think that will give a good kicker to the numbers. So I remain very positive on the company as such.
Okay, and valuations wise, it's fine. It's trading at 30 times.
Trading at 30 times looks expensive. Obviously, better to add on declines. But as I said, the palm oil opportunity which is coming, I don't think that's being factored in the price.
Okay, so that is the opportunity that you're looking at. Vivek, any view that you have on Advanced Enzymes?
Well, I would second Sangeet's view on that. I mean, even I have a positive view on the stock. It's a buy on declines. It's a very high margin business. I mean, sustained EBITDA margins of more than 40%. Return on capital, return on equity of average over the last 5 years has been over about 20%. And if we go by the management commentary and guidance, I think both the margins and return on capital, return on equity can be sustained. They have a fairly strong niche in food grade and nutraceutical enzymes that have applications there, driving into also the industrial applications. Among the few companies that has a very large spend, I mean, we're talking of like 5 to 7 or close to 8% spend on R&D. So I mean about 350 crores as he mentioned of in terms of top line. I mean the company spends about something like 20-25 crores of having an R&D budget with an R&D strength of more than 100 people, large number of them PhDs and all that. So it has all the building blocks of making a business or I would say intellectually driven business, driven by intellectual capital, patents and IPRs, etc., which will continue to drive not just the growth but high margins and high return on capital, return on equity. 30 times earnings, 32 or 35 times, I mean one could debate that whether it's current year or next year, but so long as the growth and the opportunity sustains, I think these valuations will also sustain. Post-listing, yes, there has been a correction, but that would have been, I mean, it had a stellar listing and a rally post-listing, and some bit of profit booking has only made the stock more attractive. So, I mean, just because the stock has corrected maybe 20, 25 or 30%, depending on what point of time you start looking at it, your screen says 31% over the last 12 months. One doesn't really have to be negative on the stock because of that.
But any reason that this decline actually came in? Any risks that the company is running?
I don't think so. I don't think any visible risk for what we understand. I mean, I could also put a disclaimer that I do not have, or none of us with a financial background will have a very deep domain knowledge understanding of a company of this type. So you can only take the guidance of the management commentary, which so far has not disappointed.
Okay. So it's a 2 thumbs up that's coming in on Advanced Enzyme. Samir, what's your view?
So I'm a little bearish on it. I'll give you a reason. What high margins are being talked about, if you go 3 years or 4 years back, they were around 53%, which has come down to 42. So that high margin is somewhere going out of the system. Now, whether it's a pricing issue or the raw material issue, if you see the numbers, this quarter numbers, the cost of raw material was 21% of the revenues. Last year it was 14%, the same quarter. So there's a 7% cut out of the revenues. So the main revenue raw material which they use is the crude enzymes. Otherwise, if you see, the crude was down, but the special product which they use, the prices were up around 40% globally. So that kind hurts the system. And see, the only point is, if you keep on investing that 20 crores or 25 crores of R&D, that kind of a capex somewhere has to take out the revenues or the benefit. So that is more like a 5-year, 10-year story where the products, there's a pipeline of the R&D. And the only point of their R&D, if you see enzymes as a global reach, the enzymes, the R&D costs are high. But the only point is the successful launches are very few. So there's a high capex cost with the high risk of the product line coming out. So I think I'm a little negative on the firm, because the only point is, when it got listed, it was like a specialty firm. And if they can come back with the margins, I think I'll be better off then. And secondly, they've bought a Evox technology, which is a German firm. So that was already a bit negative. So that has also affected the numbers.
Okay. Sangeet, any view on this acquisition that they did? Is that a concern? Will that play out on the financials?
Well, obviously it's premature to talk about it. Generally, acquisitions are done taking into account the long-term synergies and the benefits. And we are yet to see the numbers, coming from that synergy. So too premature to talk about those acquisitions as such. Well, but I'm very confident on the management. I mean, they have delivered in the past, and maintaining an EBITDA margin of 40% plus is by no standard, I mean, it does signify a lot of pricing power in their business, a lot of business moat.
Yeah, you want to say something?
No, because see, eventually it's come down from 53. So if tomorrow, next 2 years, it goes to 35, it's still not a high margin business, right?
Okay.
We are talking about margins because these products stay for at least 4-5 years with the clients. So the pricing power, I agree, they have. But the only point is the kind of capex they are doing in the R&D, that's somewhere or the other not fruitful enough to maintain that kind of margins.
Okay, so that's the view that's coming in on Advanced Enzymes, to extremely bullish view that's coming in on the stock. But Samir here has a cautious view on the counter, given the fact that margins have come down from levels of in excess of 53% now to levels of close to 40%. So that's his bone of contention for being slightly negative on the counter. Let's move on to the next stock, and that is consumer. That is Crompton Greaves Consumer. The counter has been rallying over the past few days. It's a lot of consumer durable stocks have been doing well. It's up almost 76% this year. Is this the best play in the consumer durable space? If you're looking at it, ROA, ROE of in excess of close to 20%, but the valuations, it's trading at 50 times this year. This year's multiple. Samir, I'll start with you. Any view on Crompton Greaves Consumer?
So I'm neutral on the firm, given the valuation has gone a little bit up. Second, see, they have two major products, which is the fans. They have 25% market share. They're the leaders over there. They're very interesting is the pump side. So they have these residential pumps where they have 25% market share. So these two are cash cow for them. But eventually, a while back, they were fighting for Kenstar through Videocon. So they are looking to diversify into more products. So they use that cash flow which is getting generated from the fan and pumps. See, I see a lot of upside within fans and pumps because right now the unorganized to organized play is going to come into GST. Now when you defocus from those two main products which you are having a cash cow and you defocus from other products which you want to play where there are already a lot of competition, I think it will be more cash burn rather than cash creation system. So I will be neutral and I would like to see how it goes.
So you're saying that they shouldn't diversify into what they did?
See, my only point is if you have a leadership and you defocus, generally that happens. And when others are also entering your segment. So there are a lot of people who are trying to enter that fan segment or premiumizes. So when you lose that kind of a focus in that, it's not about losing the focus, it's about deploying the cash. I as an investor rather want you to deploy more cash in the same segments which you are creating more money.
Okay.
Rather than creating new segments and burning cash for the next 3-4 years.
Okay. Vivek, what's your view and any comment on what he's saying in terms of defocus that could probably come in? Is that something that would be...
Well, I don't think that the management by any means is defocusing on their main businesses. The main businesses will continue to grow at mid-teens, I would say conservatively, driven by multiple factors. One of the important factor will be power for all. I mean, a lot of villages, semi-urban areas which never had power or never had reliable power. The moment they have power, the first thing that they're going to have is the lighting and the fans, which is the first thing that... so there's going to be a deeper penetration. Unorganized to organized, that story is well theoretic. So it's not that there's a defocus. It's a fantastic business that throws up free cash flows hugely. I mean, in the sense, over the next 5 years, my estimate would be that there would be free cash flows of something like 700-800 crores.
Okay.
So any management, any prudent management is going to be looking to diversify into related products where they can have synergies on the distribution side, on the marketing side, on the branding side. So a bid to acquire Kenstar or any other company or product category acquiring a smaller player which gives them an entry which they can scale up, I don't think is either a defocus or cash burn. In any case, even Kenstar, it's not that they were bidding for something which was loss-making. Kenstar was also profit-making company. Now, valuations is something which one can debate endlessly, whether they were overpaying or not. In any case, now they're out of the race, so it's off the table from that point of view. Purely from a business point of view, return on capital, return on equity, you adjust it for the surplus cash on the balance sheet, which only gives them treasury gains. I mean, there's a company that does return on capital, return on equity in excess of 50%. Growth of mid-teens. Yes, valuations, no doubt, are demanding. I mean, at 50 times current year earnings or about 38 or 40 times next year, that is financially 18-19, yes, it's demanding, no doubt. But on declines, it definitely does make sense to invest from a long-term point of view, and I have no issues on that. I mean, this could be in future, maybe if we were to look 5-10 years down the line, it could be another Havells in making. From that point of view, Havells also at one point of time started with a single product and then diversified into entire range of consumer electricals. Both
well, what would you select between a Havells and a CG consumer?
Well, if we are talking of prices as of today, then Havells looks much better. But I wouldn't rule out an investment in Crompton Greaves electricals as well. I mean, when I say on declines, I mean maybe a 15-20% price decline and a correction is quite possible after the stellar rally that they have had. So a price of maybe in the vicinity of 225-230 makes it an attractive long-term bet.
Okay, Sangeet, price versus growth, valuation versus growth for Crompton Greaves, what would you select?
So I'm very positive on the company. I think majority of the points are covered by Vivek. However, the point regarding diversification, so I don't see that as a concern. I mean, that would have been a concern had they ventured out into some unrelated territories. So maybe starting an FMCG company or starting a real estate project or something. But diversifying their existing product range, these ultimately all comes under the garb of electrical products. That's where their speciality is. And last 12 months or so, they have been consciously focusing on premiumization. So like launching an anti-dust fans or even the pumps and all. So I remain very positive. Yes, valuations are demanding, so better to add on declines, but I like the company.
Okay, so that's the view that's coming in on Crompton Greaves consumer. Positive views from two of our guests. Slightly cautious view that's coming in on from Samir also on this counter. Let's move on to the next stock, and that is TRF. The counter was up almost 35% last week. Let's see what it's down 5% today. It's a Tata Group company, one of the smallest Tata Group companies, but it's done well over the last week. Over the year, it hasn't done well. What's buzzing in the counter? Is there something that's happened that the street has missed? And what should one do with TRF? I'll ask Samir, any view on TRF?
So TRF, I'm bearish on it. Because see, it's a loss-making firm, and the subsidiaries are heavy loss-making firms. So in 2017, 16 and 17, if you read the auditor reports, the auditors themselves, which was Deloitte and Haskell, they had flagged off the going concern part of the firm. So they have around 211 crore losses accumulated, which was flagged off by the audit firm and saying that the going concern will be difficult until and unless it is addressed. The firm replied by saying that they have 255 crore receivables, which would set it off depending on the completion of the projects and everything over there. That hasn't happened in the past 1 year. This I'm talking about 2016. So I don't know what will change or what has changed last week for the stock to go 35. I'm only seeing that it's a illiquid stock. So maybe a little liquidity pushed the price up.
Okay. Sangeet, any view on TRF?
So I don't have a view that why the prices has changed for last 1 week. But again, I also remain bearish on the stock. The company was under the BIFR for restructuring, but now with the IBC coming, so they'll have to again initiate the process for corporate restructuring. It is into material handling equipment, port equipment. If you see the receivables, they are close to 50% of sales, and majority of them are above 6 months old. So I don't see how the situation is going to improve as such. If you see last 4-5 years, so they have seen a cycle, but the numbers continue to deteriorate. So my concern remain on the numbers.
It's very surprising that it's a Tata Group company, and with all the changes that's happening in the other group companies, I don't think there's any focus on TRF.
So they have planned to change the management in June. They announced it, but the management hasn't changed yet.
Okay.
So let's see. Maybe that is happening.
Okay.
So there used to be a company called Tata Metallics.
Yes.
There is a company called Tata Metallics. They used to run into a similar set of fashions about 10 years back. Fortunately for them, they had a management change and a business change. And they turned around, for last 4-5 years. Even if you see the price chart or the earnings chart of Tata Metallics, that itself shows that, the management's focus coupled with the areas where they operate. If things change there, then you
So I think we need to watch out if there will be any kind of change. Vivek doesn't cover the counter, so he does not have a view on it. But that's the view that's coming in on TRF at this point of time. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we'll talk about is Westlife Developers that operates the McDonald's brand. The counter is trading at a 3-year high. Will the rally continue? Obviously, valuations extremely expensive on an FY19 basis is trading close to 100 times. So, is this something that you would venture into? We'll ask our guest. Vivek, I'll start with you. Westlife.
Well, I'm extremely bearish, and there are multiple reasons. I mean, fundamentally to start with, any business is supposed to be growing and generating profits. Westlife doesn't do that. I mean, if we look at, leave aside the last 2 quarters, I mean, the previous 5 years that it has been in the public domain that the numbers are available, it's hardly made any profits at EBITDA level, cash level, or net profit. I mean, there have hardly been any profits in the first place. And is the business good? Excellent business. I mean, you have one of the leading brands of the world in the food business. McDonald's, you can't have a better brand than that. In one of the largest markets, fastest growing markets for out-of-home food consumption. And after 20 years, by the way, McDonald's in India had launched in 1996. So even after 20 years, the company barely manages to make any meaningful profits. And I have been listening to the management commentary frequently, not every quarter, but from time to time. And the reasons just seem unconvincing. That's the fundamental issue that I have with Westlife in terms of And if we look at comparables, and I'll look at two comparables, one direct comparable, the other McDonald's franchise which is in the private domain and has got dispute with McDonald's Corporation, the Connaught Plaza Restaurants, which is Delhi-based company which operates North and East India. For their numbers which have been reported in the newspapers, that venture seems to be having much higher profit margins, much better cash flows, return on capital, return on equity. And West and South India, which is actually much better geography to be operating in, one wonders that same business in a better geography, why is this company not making as much profit and profit margins as the other McDonald's franchisee, North and East India? That's one thing. If I were to look at another comparable, I mean, the way Jubilant Foodworks has scaled up in the last 10 years or so, or a Cafe Coffee Day, the way they have scaled up the cafe business, all of them are in the realm of food consumption which is out of home, or order, and the restaurant business, quick service restaurants, if you may define it that way. So this management itself doesn't give confidence when I look at comparables, that how long do I need to wait for that promise for this company to be delivering both growth and profits? And 2, 3, 4% return on capital is just not adequate to be justifying investment. The stock may be at 2-year high. Look at a 5-year chart. This stock used to be at 440 sometime in 2013 or 2014. And in the entire bull market, the stock actually had fallen 50% purely because of the bad performance. Now maybe as part of the bull market, it's again risen from the lows. But since the time this company has been in public domain, it's just been an underperform in every which way. Okay, Samir, do you agree with the concerns that are there on Westlife?
Yeah, the concerns are right. I am neutral on the stock. But the only point is, if you see North, the North's franchise, they stopped doing capex 3 years back. So any which way, though, there was no new additional, because of the disputes and everything, the capex stopped off the firm. So the cash flow keeps on generating over there. Out here, what has happened from 2012 to 2017, it's become from a debt-free company to a debt company. So it has around 190 crore debt, which has gone into new store openings. So they did a lot of major expansion in 2015 and 14. So which were negative. So usually their payback is 1 or 2 years. So that payback should have hit 17 or 18. But because of the kind of demand they saw in 14 and 15, it has prolonged to a 3-year kind of period. So everyone, I think, is now accounting for a 2019 or 20 kind of those
so that is when
stores.
You will probably have a
so that kind of a cash flow or that kind of a repayments, and they have to slow down the expansion mode. Now, who own? Do they bid for the North and South, North and East? I don't know. But if they do, it'll be a big thing because they have the whole monopoly over there. So that kind of a cash flow in 19 and 20, if they come. Right now, I think it's a neutral.
Sangeet, what do you make of Westlife?
So I'm neutral to bearish on this stock. I think reasons are pointed out by Vivek. You have a EBITDA margin of close to 8%, you know, which hardly warrants any investment. And this is not a new brand or a new business that they have started. It's a fairly matured brand, you know, and for a matured brand like McDonald's, you would expect a higher EBITDA margin or higher profitability. Having said that, the last quarter or the last few quarters, they have reported a fairly robust same-store sales growth. So that is something to watch out for. They have also extended their brands through by introducing Mac Cafe and a couple of more brand extensions, Mac Delivery and all. So we'll have to see how that pans out, but purely again, valuations don't support. So I don't see any case why fresh investment should be made at this level.
So that's the consensus view that's coming in on Westlife Development, not enough positive views that are coming in on the counter. And the final counter that we are moving on is Coffee Day Enterprises. The stock is up 15% last week. Is there more traction? Again, an expensive stock, 60 times next year, 80 times this year. We'll ask our guest. Samir does not have a view on the counter, so I'll ask Sangeet very quickly. We're running out of time, but quickly, what's your view?
So again, I'm neutral to bearish on the stock. If you do an SOTP valuation based on all their businesses, 80% of the valuation is coming from their retail coffee chain business. business. But at the current price, my SOTP valuations is about 20% lower to the current price. They also had some management issues, some political affiliations which are there. There was an IT raid which was conducted a couple of months back, and there was some undisclosed income which was unearthed. So I mean, you want to stay away from such companies or such managements.
Okay.
You know,
is that a concern you share, Vivek?
Well, I do share those concerns. I have some more concerns actually, but I'll have the most fundamental thing. Multi-business conglomerates or holding companies over the long term rarely create wealth or are value creators. I mean, there's empirical evidence for the last 30 years, not just in India, even globally. That's number one. Number two, last 15 years, another empirical evidence that managements which have political affiliations which are too close for comfort also don't create value, because eventually they tend to get into problems some way or the other. One really can't insulate. So Mr. Siddharth, who's the VG Siddharth, who's the chairman and MD, can't really say, oh, I have nothing to do with my father-in-law. He has everything to do with it. I mean, that's just for the benefit of the viewers, SM Krishna is ex-Congress chief minister and minister in Manmohan Singh cabinet, now part of the BJP, is father-in-law of the chairman of this company. That's one thing. However, I like the coffee chain business, the coffee retailing business. Fantastic business, fantastic franchise, impressive growth and scale up that Siddharth has done over the last 15 years in terms of both in terms of number of restaurants as well as growth, profitability, and when you look at standalone coffee chain business itself, coffee retailing, return on capital, return on equity, which is all fine. I would have loved it if it stopped there. But the cash flows of the business over a period of time got into investments like in Sikal Logistics, in Mindtree, I mean, holds substantial minority stakes in both of them, plus real estate, which I'm told is an old family investment, but all of it is housed in Coffee Day Enterprises. So consolidated, when you look at it, all of the return on capital, return on equity gets diluted, and there's a company that makes single-digit return on capital, return on equity.
Okay, so that's the view that's coming in on Coffee Day Enterprises. We are running out of time. But it's again a negative view that's coming in on CCD also. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Vivek, Sangeet and Samir, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.
Are we live?